Okay, hello and welcome everyone to this webinar where we will be presenting the results from CDP's 2020 disclosure cycle in Asia Pacific, where we have looked at the data submitted by more than 3,000 companies and more than 130 subnational governments. My name is Fred. I am part of CDP's corporate engagement team in Hong Kong, and I will help facilitate this webinar today. Before we get started, just a few housekeeping rules. All participants are muted on entry to avoid background noise. If you have any questions, please feel free to submit them in the chat or in the Q&A throughout the event, and we will do our best to answer them. If we are unable to answer all questions, we will follow up with you after the event. And then lastly, this webinar is recorded, and we will share a link to the recording and slide deck in the follow-up email. So again, thanks very much for joining us today, and a big thanks to our supporting event partners, the Business Environment Council and the Hong Kong Green Finance Association. As for the agenda, we have quite a bit on today. First, we have opening remarks from CDP's Regional Director, Pratima Divgi, before we are fortunate to have Grace Hui, who is the Head of Green and Sustainable Finance at HKEX, deliver a keynote speech. After that, my colleagues Elim and Hannah will present the 2020 CDP findings from corporates and subnational governments in Asia Pacific, before we move on to a panel discussion and hear from industry experts on the topic of mainstreaming sustainable finance. Finally, we will end the event with a recognition of some of the environmental leaders that we have identified in the region. So with that, I will hand it over to my colleague Pratima for the welcome address. Pratima, over to you.
Thank you, Fred. Good afternoon, everyone, and welcome to our webinar. CDP, as you know, we hold an event annually, and this is really to provide insights and trends in corporate action on climate and environmental issues. But we also use this as a platform to recognize the efforts of corporate environmental leaders in our region. This is the second year that we are conducting this event virtually. When the pandemic hit Hong Kong a year ago, our internal team, we huddled together to try and project corporate disclosure rates in Asia Pacific, and we estimated a flat disclosure rate with no new disclosing companies in the region as a result of the ongoing uncertainties. I wanted to particularly point this out to note how grossly we underestimated the sustainability momentum in Asia Pacific. Contrary to our earlier estimates, we ended up with a 20% year-on-year growth in corporate disclosures, and this was primarily brought on by policy and investor momentum in the region. Besides an increase in corporate disclosures, CDP also saw a marked interest from Asian financial institutions on climate data. Some of the largest institutional investors, such as GIC, MUFJ, Sumitomo Mitsui, and Macquarie, are signatories of CDP. And this really heralds the sign of Asia Pacific investors becoming increasingly involved in engaging with corporates on climate and environmental factors. So with sustainability disclosure now normalizing in the region, at CDP, we're setting our sights on two key challenges that we see in the coming years. The first challenge is, how do we ensure high quality reporting? While CDP is not a verifier of data, we believe there is immense need in the market today to improve the capacity of corporates and financial institutions on understanding and reporting under the Task Force for Climate-Related Financial Disclosures, or the TCFD framework. To that extent, in 2021, CDP will pilot and we will lead on TCFD and environmental capacity building programs, and we're doing this in partnership with GRI across 2 stock exchanges in Southeast Asia. We are undertaking a similar exercise for subnational governments that are yet to report on their climate vulnerability assessments or need to improve upon the quality of these assessments. The second challenge is, how do we ensure that this disclosure does not remain a reporting or compliance exercise, but is actually integrated in financial decision making? To action this, there are a few initiatives that CDP is embarking on. The first and foremost is understanding the extent of green versus brown investing and lending strategies today among financial institutions, and what these trends will look like going forward. For the first time in 2020, over 350 financial institutions globally responded to CDP's financial services questionnaire, and that we will now be able to provide insights and trends on green and sustainable finance, but also showcase metrics and targets of portfolio-related emissions this coming April. The second, how we're dealing with this is the second initiative that we're actually embarking on is how can climate disclosure data be better interpreted by financial institutions. And in this regard, we are already embarking on several research and insight projects to support the financial services industry. This slide shows you some of the areas and studies that we're already working on with some of our partners globally. And the third key focus for CDP is how do we ensure that data that is produced by corporates enables them to have access to green and sustainable finance. We're seeing instances of CDP data being used to develop sustainability-linked loans, the most recent by CIMB in Malaysia, and we will hear more on this from our esteemed panel and speakers in the remainder of the session. But CDP would like to take this a step further and see how several data points within the TCFD framework can enable or mainstream sustainable finance. Joining us today on this very topic of raising the ambition of capital markets is Grace Hui, Head of Green and Sustainable Finance at Hong Kong Exchanges and Clearing. At HKEX, Grace is responsible for bringing together her deep experience in capital markets to the development of green and sustainable finance. And she will provide us with insights on Hong Kong's position on ESG, driven by demand from mainland China, Asia, and international investors. And she will also provide us with insights on Hong Kong Stock Exchange's push for climate-related disclosures and science-based targets. Grace, very much appreciate your presence and participation in today's event. Over to you.
Thank you, Pratima, for the very kind introduction. Good afternoon, everyone. First of all, I would like to thank CDP for organizing this webinar and allowing me to share with you HKEX ambition on green and sustainable finance. Next slide, please. Hong Kong is known around the world as a leading financial center. In many areas of financial services, Hong Kong has the track record, reputation, and scale to be considered among the world's best, including having the largest asset management market in Asia, the largest offshore liquidity pool for renminbi in the world, and now the largest stock exchange in the world by market cap. Hong Kong owes much of these successes to our world-class business infrastructure, sound regulatory environment, unique access to market opportunities, diversified pools of capital, investors, financial products, and last but not least, abundant professional experts such as yourself. The world faces challenges arising from climate change and the COVID pandemic. No sector is better placed to drive the transition to a sustainable future than the financial sector. As a responsible exchange, we at HKEX want to demonstrate our strong commitment to sustainability by leading the development of green finance in the region, particularly given China's explosive growth in this area and our role as a super connector between China and the rest of the world. Japan, South Korea, Hong Kong have committed to become carbon neutral by 2050, with China in 2060. There will be a massive growth in electrification across Asia, in particular China. As an international exchange, we can guide future capital flows to support Asia's transition towards sustainability by providing a market infrastructure for sustainable asset classes. With strong commitment and conservative efforts, we believe we are well placed to become the regional green finance fundraising center. But first, we need to understand the unmet needs in ESG investing in this region. Next slide, please. Next slide, please. So what are the current unmet needs in Asia? The most talked about issues are around data availability and data quality. Currently, there are no universally accepted ESG reporting standards or frameworks. Different benchmark providers have different methodologies and weightings, which make the comparison of ESG performance difficult for investors. Verification of ESG data or assurance is not a requirement. While standard setters are working towards a unified standard, this may still take some time, although the IFRS Foundation trustees released an announcement last night which gave us some hope. The International Accounting Body said that it would set out a definitive proposal in September for global rules to govern company disclosures of risks from climate change. The second issue is about further support from the government and regulators. One of the hallmarks of Hong Kong is the close collaboration between the public sector and the private sector. This is evident in the sustainable finance sector also. HKEX is in a very good position to help drive policy changes forward as both a member of the Green and Sustainable Finance Cross-Agency Steering Group and the newly inaugurated Guangdong, Hong Kong, Macau, Greater Bay Area Green Finance Alliance, which I'll discuss later. The third issue is the availability of different asset classes. Meeting the financing needs of the decarbonization levers will require not only a significant scaling of the climate finance market, but also changes in financing solutions. While the markets for green bonds and loans, which rely on allocating capital based on designated use of proceeds, has scaled significantly, especially in this region, there is a need to scale to other asset classes, including equity, structured products, and those that connect to climate-related metrics and outcomes. These are just the unmet needs from investors' perspectives. But how about listed issuers? Next slide, please.
Hi, Grace. I'm so sorry. My internet cut for a few minutes. Can you please let me know which slide I should go to? I'm so sorry about that.
It's okay. Our ESG journey actually started 8 years ago. And as you can see, ESG has been core to our purpose as both a market regulator and a market operator, as well as a corporate since then. As a regulator, we first introduced ESG disclosure requirements in 2013 and have made changes every 2 years to keep pace with market development and investors' demand. Last year, we amended our rules to require, firstly, a new mandatory statement from the board setting out the board's consideration of ESG matters. Second, a new disclosure requirement on climate-related issues. Third, a new requirement to disclose relevant targets in relation to environmental KPIs. And last but not least, we upgraded all voluntary disclosure on social KPIs to comply or explain basis. These new requirements are consistent with international best practices. They were formed by the approach pioneered by TCFD what Pratima mentioned earlier, which is the Task Force on Climate-Related Financial Disclosures recommendations. The amendments represent a shift away from reporting to management. The focus is on board leadership and accountability of ESG. We believe that the new requirements and guidance should significantly improve Hong Kong's regulatory framework for ESG governance and disclosure, and position HKEX as a pioneer in driving ESG disclosure in Asia. We know that there are challenges faced by issuers in meeting these new disclosure standards. So in order to help their understanding, we have launched a new e-training course and also published guidance materials tailored for directors, the board, as well as ESG report preparers. We are looking forward to reading the first set of enhanced ESG reports, which should be out later on this year by those issuers with June 30th year end. And last December, HKEX officially launched Stage to connect the issuers with investors. Next slide, please. Stage, which stands for Sustainable and Green Exchange, was launched with the view of bringing the Asia's first multi-asset sustainable investment product platform. Our objective is to support the fast-growing global demand for sustainable finance. We created Stage for three primary reasons. First, we want to increase ESG information flow. Second, to provide a market infrastructure for sustainable asset classes. And third, to provide an alternative to bank finance and private equity for SMEs. As you can see, Stage is also an online repository of green and sustainable finance resources, promoting market education, knowledge sharing, and stakeholder engagement in sustainable finance. We believe that the importance of financial education and ESG risk awareness building will support both corporate and investors' transition to a low-carbon future. Next slide, please. At the heart of the Stage platform is an online product repository, which as of today features 42 sustainable theme products from leading Asian corporates, including the first ever dual currency climate transition bonds. These HKEX listed sustainable products include sustainability-linked, green, social, and transition bonds from issuers across a variety of sectors, as well as ESG-related exchange-traded products. Over time, the scope of the product repository will increase across asset class, industry, in Hong Kong and beyond. Issuers included on Stage must provide additional voluntary disclosures on their sustainable investment products, such as the use of proceeds and annual post-issuance reports. This additional information will enable investors to access a trusted, easy-to-use platform for the region's fast-growing green sector. With the launch of Stage, we are seeking to guide future capital flows to support our society's transition towards sustainability. We are therefore encouraging all regional issuers of green and sustainable products to consider application for inclusion on Stage, in turn helping to build Asian financial markets' own sustainability. I want to stress that there are no fees for joining Stage. Next slide, please. On the cross-agency steering group, which was set up by the Hong Kong Monetary Authority and the Securities and Futures Commission last year, is the establishment of a group that we refocus on green and sustainable strategy for Hong Kong. The other members include HKEX, the Environmental Bureau, the Financial Services and the Treasury Bureau, the Insurance Authority, and the Mandatory Provident Fund Schemes Authority. The steering group aims to coordinate the management of climate and environmental risks to the financial sector, accelerate the growth of green and sustainable finance in Hong Kong, and support the government's climate strategies. The steering group unveiled its strategic plan last year, which sets out 6 key focus areas and also 5 near-term action points. These points include climate-related disclosures aligned with TCFD recommendations, which will become mandatory across all sectors no later than 2025. And these sectors include asset managers, insurers, banks, and listed companies. The steering group also aims to adopt the Common Ground taxonomy, which is being worked on by the International Platform on Sustainable Finance Working Group, co-led by China and the EU. It also promotes the climate-focused scenario analysis. And it will also establish a platform to act as the focal point for financial regulators, government agencies, industry stakeholders, and academia. Next slide, please. The financial sector, including central banks, supervisors, and regulators, are making good progress in greening the financial system. There's still a lot more work we all need to do if we were to effectively manage climate risks and mobilize capital to support the transition to a sustainable economy. For example, listed companies should start thinking about setting science-based targets in advance of carbon-related regulations. It will allow you to be well equipped to respond to regulatory and policy changes. Companies can demonstrate their robust commitments to reduce emissions and help mitigate global warming to investors and clients. Investors are looking for credible and comparable ESG data. If you're looking for a TCFD-aligned platform, I highly recommend CDP, which over the past 20 years have created a system that has resulted in unparalleled engagement on environmental issues worldwide. I now pass the floor back. Thank you for listening.
Thank you so much, Grace, and thanks again for joining us today. And just to say apologies again that my technical issues were causing some trouble. We will share the slides after the event, so hopefully, everyone can catch up on the slides there. So we very much appreciate your insights today on the role that capital markets and policy can play in meeting the ambitions of a low carbon and sustainable future. This is, as you rightly say, and not without its challenges, such as the current availability of financial instruments and the need for more financing solutions. And it is indeed heartening to see the largest stock exchange by market cap take a leadership role on laying the foundations and market infrastructure to provide companies and financial institutions with this platform to meet these challenges and to further innovate on low carbon and environmental friendly solutions. So thanks again, Grace, for joining us today. Next on the agenda, my colleagues Elim and Hannah will be sharing the results of our 2020 disclosure cycle. First, we will look at the corporate data, and I'll hand it over to my colleague Elim. Elim, over to you.
Thank you, Fred. Welcome, everyone. My name is Elim Kwok from CDP's Corporate Engagement Team. I'm very excited to be here today to share with you our findings from last year. In the next 15 minutes, I will present you the key trends we identified based on the data we collected from over 3,000 companies across APEC in 2020. Let's begin with the first finding. Globally, we are seeing more pressure from investors and other stakeholders for greater transparency on climate-related issues, particularly against those that do not disclose on environmental risk. This is reflected in a significant growth in the 2020 disclosure rate. We are already seeing examples of investors divesting out of business that exhibit high carbon intensity or that do not articulate a clear strategy for addressing climate change. Companies in APEC are gearing up to build on this momentum, and as a result, we see improvement in the number of companies integrating climate-related matters into their financial planning and business strategies. Last year, despite COVID, we have reached record high disclosure numbers. Over 3,010 companies with headquarters from 21 countries or regions in Asia Pacific reported through CDP's climate change questionnaire. To put this into context, APEC accounts for around 30% of CDP global responses, and these 3,010 responses represent a 20% growth compared to the previous year. The majority of responding companies come from China, Japan, and Taiwan. As you can see here from the chart, There is also noticeable growth in other emerging markets, such as Malaysia and India. The growth is largely driven by large purchasing organization with extensive supply chain, which are requesting data more than ever from their suppliers. This effect also cascades into countries like Cambodia, where companies are reporting for the first time. Here, we have laid out our data across 3 themes. From left to right, they are climate change, water security, and forest. The questionnaires are designed to elicit comparable data from each company. We will be focusing on climate data today, but we are launching an infographic later this month, where you will find more insight and analysis on these themes, so please stay tuned for that. Going back to our findings, other than higher disclosure numbers, we also see greater emphasis on incorporating climate-related matters into financial planning. Nearly 80% of companies reported that climate-related risk and opportunity have already influenced their financial planning, among which 55% use scenario analysis to understand the implications of climate change for their business, which is a 4% increase when compared to 2019. It is considered best practice to use this forward-looking tool as it enables companies to better understand the uncertainties and financial implications of transitioning to a low-carbon economy. Close to 80% companies also reported board oversight, indicating climate issues have become a mainstream topic in corporate boardrooms. And with this connection, these corporates have established a mechanism for the board to monitor their progress of implementing climate targets and be responsible for managing related risk and opportunities on a regular basis. Moving on to our next finding, a holistic risk management approach often involves identifying, assessing, and responding to risk to make sure organizations achieve the objectives. However, our findings show most of the companies in APAC are lacking of a comprehensive approach to risk management. Companies that fully integrate and frequently assess climate-related risk across the value chain and over a range of time horizons are better equipped to handle longer-term uncertainties and liabilities. In fact, nearly 2/3 of companies have already identified exposures to climate-related risk. Of all the risks identified, 60% are associated with the transition to a lower carbon global economy. The most common transition risks relate to policy and legal changes, such as pricing of greenhouse gas emissions and enhanced reporting obligations. In addition, our data shows more companies have identified market and technology risks that are substantial to their business. For example, a Thai company from the chemical sector reported that in order to meet its government's NDC, low-carbon technology and processes such as steam recovery and high-efficiency motors must be applied in all new investment projects. Otherwise, they may not be able to expand their business. Among physical risks, acute risks such as the increased severity of weather events like typhoons and floods remains as an overriding risk. As geophysical effects of climate change have become more apparent, the common perception that all climate-related risks are long-term no longer holds. To minimize such risks, companies have adopted wide-ranging adaptation and mitigation measures. For example, a developer from Southeast Asia reported adding additional climate-related resilient features such as water level sensors and water detention tank to their new and existing building, located within the high flood-prone areas to prevent property loss. The previous slide displayed how companies are taking a broad view of both physical risk and transition risk, which then brings us back to the importance of having a comprehensive risk management process. Over 70% of companies in APAC already have a process for assessing and managing climate risk. It can be a process that is integrated into centralized enterprise risk management program, or in short, ERM, covering all types of risks. And our data shows 8 out of every 10 companies are now assessing climate risk annually. It is likely due to the high-level integration of climate risk into company-wide ERM, and so they are always included along with other material risks which the company is exposed to. On top of that, slightly over 40% are performing climate risk assessment more than once a year, which is regarded as best practice, as it helps increasing investor confidence and allows companies to respond based on the outcome of risk assessment. Dauntingly, we found that nearly a quarter of companies include all stages of their value chain when performing risk assessment. This is potentially problematic because this implies they may not have an accurate picture of threats to their value chain. Next, we will use manufacturing sector as an example to highlight the importance of evaluating all value chain stages. Among 3,010 companies responding from APEC, nearly 60% are from the manufacturing sector. Thanks to globalization, today's supply chain is extremely complex and highly interdependent. While this brings many benefits to business, it also introduces new risks to supply chains. And without sufficient resilience, shocks like global pandemic can cause major disruption that spreads through global value chains. Our data shows that despite a high percentage of companies in this sector having integrated climate-related risk into their ERM, of those, less than 1/5 of manufacturing companies cover all stages of their value chain in risk assessment. This explains why, as shown in the pie chart on the right, up to 70% of identified risks occur within their direct operation. In other words, most manufacturers have no visibility into the risks and potential impacts that lie in their upstream and downstream value chain. The low percentage of risk occurring in other parts of value chain is likely caused by incomplete coverage of risk assessment. It is noteworthy that 36% of reported climate risks are most likely to happen short term. This suggests that many manufacturing companies now see climate change as an imminent threat. Given the extensiveness and complexity of the value chain, manufacturing companies need to step up their efforts in risk management. And finally, we come to our last of the findings. In 2020, more companies in APEC are setting targets that are aligned to climate science. This is an indication that more APEC companies are making preparations for a company-wide transition to a low-carbon economy. Science-based targets provide companies with a clearly defined path to reduce emissions in line with the Paris Agreement goals. The private sector plays a fundamental role in reducing greenhouse gas emissions. Therefore, embedding science-based targets in sustainability management is crucial. In 2020, almost 2/3 of companies have active emissions targets in place, including both absolute targets and intensity targets. This means the majority of companies in the region are committed to reduce emissions and are allocating resources to realize their targets. Given the high rates of companies setting targets, we are also glad to see that the practice of setting climate targets has led to emissions reduction in the region. In 2020, 45% companies reported a decrease of their Scope 1 and 2 emissions when compared to previous reporting year. Companies have undertaken various emission reduction actions to achieve these curbs in emissions. From the table, we listed here some of the most commonly cited examples of how capital is directed towards emissions reduction activities, such as dedicating budgets for improving energy efficiency and production, and budget for stronger focus on generating and consuming low-carbon energy. Similarly, an internal price on carbon helps companies assign a monetary value to lowering emissions. An example raised by a construction company is that they have made special provisions for their high impact projects so that the higher expense caused by purchasing renewable energy can be fully absorbed within the global operations budget. This ensures that incorporation of renewable energy into major projects will retain a priority at the company level and not a matter for individual project budgets. Despite the progress we see on target setting and emission reduction, we have to bear in mind that the corporate emission targets can be approached inconsistently, making it difficult to evaluate how ambitious these targets are. Hence, we need a framework that translates climate science into a set of robust criteria that allows independent assessment of these targets based on transparent validation protocols. And it is also where the Science-Based Target Initiative comes into the picture. In 2014, CDP alongside UNGC, WRI, and WWF founded the SBTi to drive ambitious climate action in the private sector by enabling companies to set science-based emission reduction targets. Fast forward to 2020, when more companies than ever were setting greenhouse gas reduction targets aligned with climate science. Last year, there were a total of 263 SBTs in APEC, which is a 57% increase over 2019. Among the SBTs, more than half have had their targets validated by the SBTi, and the rest have committed to having their targets validated in the near future. To hold off some of the worst climate impacts and avoid irreversible damage, the latest science suggests we must hold temperature rise to 1.5 degrees above pre-industrial levels. This requires hitting net zero emissions by 2050. And as momentum builds towards race to zero, 48 companies in the region are now aligning their science-based targets with a 1.5 degree future to meet the most ambitious goal of the Paris Agreement. I will conclude with this map showing the country breakdown of SBTs uptake in the region. One thing that the map tells us that companies from all sectors and countries across the region are taking strong steps to align their businesses with climate science. As an increasing share of companies commit to disclosure and action on climate, companies that do not do so will risk falling behind their forward-looking peers. To briefly recap, today's key findings that although many companies are increasingly integrating climate-related issues into their strategy and setting better targets, most companies will need to take a more comprehensive approach to risk management. It is the time for larger companies to step up their efforts, and that APEC companies just beginning their sustainability journey will find many role models in the region. With that, I would like to hand over to my colleague, Hannah, to present what climate action subnational governments in APEC are taking to reach their goals. Over to you, Hannah.
Great, thanks, Ellen, and hello, everyone. Thank you for joining us today. As Ellen mentioned, my name is Hannah, and I'm responsible for leading CDP city, states, and regions work across Asia Pacific. CDP has also been enabling local and subnational governments to disclose on climate and environmental impacts and actions alongside the private sector for 10 years now. So I'm really pleased to be able to present some key findings from the 2020 Asia Pacific data. So in 2020, we saw a slight increase in the number of disclosures with a total of 116 cities and 17 states and regions. So as you can see here, the highest disclosure rates we saw were in Australia, followed by India and Indonesia. Of the cities that disclosed, almost 80% of them reported having a greenhouse gas emissions inventory in place, which is, of course, the foundation to understanding what the sources of emissions are and therefore where to prioritize reduction in actions. In comparison to 2015, when the Paris Agreement was signed, this is an increase of almost 4 times, which shows that Asia-Pacific cities are increasingly able to point to the key emission sources due to activities related to some key overarching sectors, which are stationary energy, which includes residential and commercial buildings, transportation, waste, industrial processes and product use, and finally agriculture, forestry, and other land use. When it comes to ambitions to reduce emissions, 67% of cities have reported that they have set some sort of emissions reduction target. Again, if we compare this to 5 years ago, this is almost 3 times more cities with targets in Asia Pacific. Importantly, 7 times more cities in the region are now setting net zero targets since signing up the Paris Agreement, showing a growing momentum and increased ambition at the local level. Net zero targets reported by local and subnational governments range in time scale from 2025 to actually the majority of the targets set for 2050. We see that most of the reported targets are from Australia, as you can see here, with a total of 11 out of the 17 that were reported. Just one point to note is that these are self-reported targets, and we're aware of net zero targets set by disclosing governments that may not yet have been reflected in their CDP reporting. So how are cities in the region working to achieve these targets? Here you can see the most commonly reported actions with those related to the waste sector, so specifically recycling and composting facilities topping the list. This is followed by energy efficiency and retrofit measures in buildings, which is often seen as lower hanging fruit and results in direct cost savings, as well as shifting the energy supply to low or zero emissions generation. The next most reported action taken by cities is improving the fuel economy of motorized private vehicles, although it's worth noting that we're not seeing as much action when it comes to public or non-motorized transport. And finally, around using more efficient technology for outdoor lighting, such as street lights. This shows that there's a range of actions that cities are taking, and they're not just focused on one specific sector. At the same time, we see that just over 40% do not yet have a climate change mitigation plan in place, and this is a gap that needs to be closed in order to turn targets into concrete action without any further delay. While we are seeing an increase in the number of net zero targets, which is fantastic, the current reality does show that only 27% of cities are reporting a decrease in emissions since the previous year. So while it's likely there are multiple reasons for why this is the case, we did a deeper dive that shows us that the time frame of targets may have an impact on immediate action and results. So as you can see here, an even smaller percentage of cities at 20% are reporting a decrease in emissions if they only have a longer term target for 2040 to 2050. On the other hand, almost 80% of cities have with an interim target for 2030 or earlier reported decreased emissions since the previous year. The stark difference indicates that long-term targets without any means to track in the interim is in fact potentially delaying action. There's a risk here that leaving it too late may make it even more difficult to keep global warming to 1.5 degrees Celsius. As we know, shifting to renewable energy in cities is also critical to achieving net zero. However, only around a third of cities in Asia Pacific have set renewable energy or electricity targets. There are a number of challenges cities face in trying to shift their energy supply to more renewable sources, with the most common barrier reported as a lack of control over the grid. Oftentimes, the control sits at a higher level of government. So in many cases, that would be at the national level. And therefore, cities do not feel that they have the mandate and ability to change their energy mix to cleaner sources. Having said that, cities have been finding ways around this, as shown through a few examples here. So in Tokyo, a power purchase agreement that leads to the introduction of renewable energy equipment through procurement by businesses and administrations is being introduced. In Taichung City, the government is providing a subsidy program to reduce the cost of solar PV installation. And in Melbourne, they're working to advocate both the state government of Victoria as well as the federal government to set ambitious renewable targets themselves. And this is a way to address the challenge of the grid being controlled at higher levels. While shifting towards renewable energy generation is absolutely critical, increasing energy efficiency shouldn't be underestimated. And this is largely seen as a win-win for cities that result in energy and cost savings, not just for the government, but also for their residents as well as businesses. However, perhaps surprisingly, only a quarter of cities have in fact set an energy efficiency target. We see that of the targets that have been set, that they span across many sectors, namely the commercial, residential, and public buildings or facilities. So what are some of the barriers cities are facing in setting energy efficiency targets? In some cases, there's a lack of technical capacity, as reported by Balikpapan in Indonesia, while on the other hand, a number of cities are implementing energy efficiency actions without having set an overall target to work towards. And similarly to renewable energy targets, we see that some cities aren't able to do so as it's not within their control. For example, Wellington states that energy efficiency is not within the jurisdiction of local government, while they're advocating for the central government to tighten standards. So while stationary energy tends to be the largest source of emissions in most cities, this is usually closely followed by the transportation sector. So mobility of residents and workers in cities continues to be largely through transport that relies on fossil fuels with, as you can see here, very little traction gained on decarbonizing the way we move people around cities. We can see here that across private vehicles, buses, and municipal fleets, that cities are reporting a nominal shift towards electric or hybrid options. Cities setting net zero targets recognize the need to decarbonize mobility and transportation and are taking action. For example, in Newcastle in Australia, the City Council is encouraging the uptake of 10,000 electric vehicles through installation of renewable energy-powered public EV charging stations and other incentives, as well as converting council fleet to EVs. Many cities around the world, such as Adelaide, are also increasing bicycle infrastructure to make zero-emissions mobility more accessible. And of course, we can't forget about financing. Climate and environmental action requires financing and investment. In Asia Pacific, cities reported a total of 63 projects equivalent to $195 million US. While this provides a potential investment opportunity, there are a number of barriers faced by cities in securing funds for low emissions and resilient infrastructure. One key gap is that just about half of the projects reported are either in the scoping or pre-feasibility phase, meaning that they're not considered bankable. While there is work being done to address this, the pace at which cities' actions in Asia Pacific need to be implemented requires rapid unlocking of investment in sustainable infrastructure in cities in order to achieve net zero emissions by 2050 at the very latest. So that's actually it from me. And I just want to say thanks again for being with us today. So I'll hand it back over to Fred.
Thanks very much, Hannah, and thank you, Elim, for the presentation. I see that we've gotten quite a few questions already, a lot of good questions as well. And so in the interest of time, we will keep going now, but hopefully we have some time towards the end of the event. Otherwise, as I mentioned earlier, we promise to get back to you all after the event. So next up on the agenda, we have a panel discussion on the topic of mainstreaming sustainable finance. We are pleased to be joined by a group of seasoned sustainability experts, including Ms. Luann Si, who is the head of group sustainability at the CIMB Group, Mr. Mark Harper, Group Sustainable Development Manager at John Swire & Sons, Ms. Ellie Tang, who is the head of sustainability at New World Development. And to moderate the panel, I am happy to introduce Dr. Keith Lee, who started his career in investment banking and now leads the WWF Asia Sustainable Finance team to accelerate the adoption of responsible investment best practices across Asia. Keith also leads engagement with commercial banks and regulators in Japan and South Korea, and has shared his expertise in WWF sustainable finance reports and academic journals on the environment and sustainability. So with that, I'll hand it over to you, Keith.
And thanks, obviously, to CDP and Pratima for having me moderate this panel. It's a great pleasure. So before we jump into the questions, probably worth saying a little bit more about our panelists. So try not to repeat too much what Fred already said, but just for way of additional background. So we have Ellie, and Ellie at New World Development drives New World Sustainability Vision 2030 across their group via various ESG activities. Luann with CIMB, she heads up Group Sustainability and Corporate Responsibility, and she has the responsibility for transforming CIMB into a leader in sustainable finance and responsible banking in Asia. And last but not least, we have Mark, who is the Group Sustainable Development Manager at John Swire & Sons, and he's responsible for their group ESG disclosure and development of strategy on waste, water, biodiversity, and climate resilience. So really interesting panel today, and really happy to have you all here. I guess we'll just jump straight into it. So, for Mark, my first question is for you. We have two companies in Swire Group, Swire Coca-Cola and Swire Properties, that have set science-based targets. And obviously, this is a key aspect of climate strategy, as we've heard from the prior presentations. So, Mark, can you explain a little bit about how SBTs fit into Swire's overall climate strategy?
Thank you very much for the question, and thank you very much to CDP for inviting me along. I should probably start by maybe giving a little brief introduction to who Swire is for all the people who are not necessarily from Hong Kong, so might not know. So Swire is a diversified international conglomerate, and we have operations in the property, aviation, food and beverage, shipping, and trading and industrial sectors. So we're a very diversified business. In relation to your question, I think it's important to say that climate's a key part of our group sustainability strategy. We launched Swire Thrive in 2016, and we're just about to relaunch it with some rather significant changes to that strategy. But the backbone to our climate strategy under Swire Thrive starts with our climate change policy, which looks at mitigation, looks at adaptation, as well as building the adaptive capacity of our businesses. So clearly, science-based targets fall under the mitigation area. And you're right in saying that both Swire Coca-Cola and Swire Properties have had their science-based targets approved by the SBTi, and they are committed to the 1.5 degree pathways. Our overall commitment to climate change is driven by the fact that we are committed to achieving net zero by 2050. And within that, obviously, it's important that we set aggressive targets. So we've been working with our businesses to essentially develop operational specific targets for their businesses that follow one of three pathways. So the first pathway is the science-based target pathway. And so far, as you say, those two businesses have had their SBTs approved, and 5 other businesses within the group are committed to setting a science-based aligned target. In addition to that, because we operate in aviation and shipping, which currently there isn't a science-based target pathway established, although they are under development for those industries, those businesses are committed to following the industry-specific targets. So that's the CORSIA agreement for aviation, and the IMO, the International Maritime Organization's target for our shipping businesses. And then finally, for the smaller businesses within the group, they've agreed to set targets aligned with the nationally determined contribution targets of the countries in which they're operating in. So those are the sort of three pathways that our businesses are looking at setting their targets. And to support that, we've established an internal fund. It's a 100 million Hong Kong dollar fund, which renews annually, and that's there to help fund research and development projects, innovation projects around climate, as well as the other areas of the Swire Thrive strategy. It's important to say that I think that mitigation only fulfills half of the picture. So from an adaptation side, we're just finalizing a major piece of work looking at climate risk. So we've partnered with an organization called the Climate Service to conduct a detailed climate risk assessment looking at two separate pathways, so RCP 4.5 and 8.5, to look at how climate change, both physical and transitional risk, could impact our most valuable assets within the group. So we've completed a study looking at around 1,000 of our main assets within the business. So yeah, it's SBTs are a significant part of our climate strategy, but it's as I said, it's only half of the picture really. There's the whole adaptation piece that's also a significant part.
Thanks, Mark. Ellie, so New World Development, I know you're hopefully on the way to setting SBTs. So you haven't quite gotten there yet, but you have been working on your sustainability disclosures and TCFD reporting. So can I ask, how have these helped with the successful issuance of your recent sustainability-linked bond? On your roadshow, did you have to address questions around New World's wider climate governance and strategy as well?
Question, Keith. Again, for the interest of our audience, I think it might make more sense for me to give a brief introduction of what New World Group does and who we are. So we are also a listed conglomerate headquartered in Hong Kong, and we have diversified businesses in property, development, investment, healthcare, financial services, infrastructure, construction, and so forth. But property remains our core. So the New World Sustainability Vision 2030 that you kindly mentioned in the introduction actually covers all of our major business units, including property and non-property businesses. So the reason behind establishing this UN SDG benchmarked strategy is to help all of our different customers and internal stakeholders understand what the material issues across sustainability topics really are. So this strategy basically has 4 key pillars of green, wellness, smart, and caring, which you can see that they're relevant to the different portfolio businesses we have. So based off of these 4 key pillars, we have been very transparently reporting our strategy and our different targets and our ongoing performance in our annual reports and to investors on a more timely basis. And this has definitely helped every different stakeholder group understand, how we're performing and the reason behind every single initiative. And I think at the end of the day, transparent and regular disclosure gives different regulators and investors confidence that we can deliver what we promise. And in the event of us failing to meet any target, we will also explain, what had actually happened and what are the improvement measures we have in place to get back on track. So the sustainability-linked bond you mentioned is actually not the first sustainable finance instrument that have been done by New World Group. Ever since we structured our sustainability around our SB 2030 in 2018, we have been able to standardize our overall sustainability approach, including for our core property business. We take a life cycle management approach to basically set different targets for development stage, construction, operation stage, and all the way down to how we go about engaging with our tenants, our customers, and communities, and at the end of the day, disclosing our results. So this overall approach has additionally given investors confidence that we will, stick to our SOP per se for every single stage. For example, in building new buildings, we will strive for, say, getting the Hong Kong BEAM Plus Green Building Standard, the certification at the second best level. And for Grade A office buildings, we will additionally seek LEED certification for new buildings. And increasingly, during the operation stage, we will reference our Sustainability Vision 2030 target of reducing our carbon intensity by 50% based on 2015 levels and so forth. So this very standardized and transparent approach has allowed us to borrow Hong Kong's very first green loan back in 2018. And to date, we have done a sustainability-linked loan in the end of 2019 and then issue a green bond in 2018. And the sustainability-linked bond that was issued at the beginning of January actually marked our 7th to 8th product in this space. So there have been very few SLB issuers around the world because the structure poses a real challenge on corporate issuers to really hold themselves accountable and to deliver a very ambitious target. And if they fail to meet this KPI, it usually comes with a step-up penalty to the corporate issuer. But at this stage, after standardizing our approach, New World feels that we are ready to take on this challenge. Therefore, we issue this SLB to drive a target of going 100% renewable energy for all of our Greater Bay Area rental properties by 2026. So to your question about, what are the challenges that were posed by investors or the, tough questions that we got. So it basically comes, in the full spectrum. I think for investors that know New World quite well, I think they were very glad to see this move, but they want to understand why SLB, why we picked this particular instrument given its challenges, and why GBA, Greater Bay Area, as a geographical focus. As well as, how we go about selecting the target of 100% renewable energy and how we're going to get there in about 5 to 6 years. But because we have been very transparently disclosing our strategy and our ongoing performance, as soon as we, lay out the facts and the projection in terms of our carbon reduction trajectory, and our upcoming commitment to the 1.5 degree scenario under the Paris Climate Agreement, I think that has given investors a lot more confidence that we will get to our KPI under the sustainability-linked bond. Keith, I think you're muted.
Thank you. Rookie mistake. So, Luann, turning to you, clearly there's increasing need for financial institutions to pay attention to companies' exposure to climate risk and how they're addressing that. So how is CIMB looking at this and engaging with corporates over this topic?
Yeah, maybe I'll, again, just start with the introduction as well to CIMB. So especially because, we're not a big name in Hong Kong where you guys are. We are the fifth largest banking group in ASEAN, headquartered in Malaysia. We're in 14 markets and all ASEAN countries. Asset size of about 160 billion USD, so just to give you an idea. And we just started looking at sustainability in late 2018, so this is something that is quite new for us. However, because we are pretty committed, we've got a very, very strong buy-in from the top. We have kind of jumped in head first into committing to the principles for responsible banking, as well as the collective commitment to climate action. So there are a lot of things that we are doing, despite our, young age in this sustainability journey. Now, there are a lot of things that we are doing with our clients, and when I say, clients, I know many of you here are, from businesses when we talk about, corporate lending and sustainable finance, but we also have a lot of clients who are in the SME space, sole prop, and we even have products, for example, For the consumers, we've got things like green deposit accounts, better rates for greenhouses and green cars. Coming back to engagement with our clients, though, the whole question of climate risk and how businesses see climate risk, as well as just overall sustainability in ASEAN, which are, very much developing markets apart from Singapore, is really a quite nascent. So, for example, the stock exchanges have put out some sustainability reporting requirements, but the requirements are pretty, I would say, high level. And in terms of any meaningful disclosure, even talking about measuring of carbon footprint, all of that is very much limited to the very largest companies, and for sure not in the mainstream for now. Engagement is, in fact, one of the key challenges that we have because of the state of the market, and the only way we can further our goal is also by kind of bringing the customers along, making them aware of these the risks. Of course, there are many opportunities. So, for example, when they take financing from us, but also through things like conferences and workshops that we just do as a matter of day-to-day. But also, we are working with people like the regulators to improve the overall regulation and standard of sustainable finance and in the country overall. Because in the banking industry, if as a single bank who is very, very kind of strict on environmental standards, just as an example, and if all the banks, the other banks are not following, you are just essentially pricing yourself out of the market. So this is something that we work on a lot, where we try and pull the entire industry with us.
Thanks, Joanne. Mark, coming back to you. So this idea of SBTs is obviously key to this conversation, and alongside your two companies in Swire Group that have set SBTs, there are 1,000 plus that have either committed to or already setting or have already set one. So clearly there's a benefit and a business case, right? So would you mind elaborating on that from Swire's perspective?
Sure. So I think Ellie actually covered this quite well around the benefits around just having a solid sustainability strategy and solid sustainability disclosures, because the benefits are very, very similar. So firstly, I think there's a huge element around investor confidence. So the fact that this is a third-party approved target that's aligned with the Paris Agreement, it allows investors to feel comfortable that the targets that they are supporting, whether it's through a sustainability-linked loan or through any other green finance mechanism, that they're not exposing themselves to potential accusations around greenwashing. So I think that's massively important. I think another aspect is that from an internal perspective, and Grace touched on this in her presentation, is that it helps companies prepare for potential future regulatory changes. So having set a target that's aligned with the Paris Agreement, it prepares us for any potential price costs that may come to the business in relation to any carbon pricing that may be brought in particular markets. And the fact that China's looking at this quite seriously is obviously something that, as an Asia-Pacific company with a strong portfolio in China, is something that we need to take very, very seriously. Another area, and it's relatively straightforward, really, and quite obvious, really, is that it aligns with, it gives us access to potential cost efficiency savings as we look at improving our efficiencies, our operational efficiencies. It allows for saving electricity, saving on fuel bills, and all of that helps with the bottom line. I think it also helps drive innovation within the organization, because the targets are that aggressive and go so much further than just a simple efficiency savings. And so it allows us to look at new models of energy supply. It looks at allows us to look at new fuel supply. So, for example, our shipping division has been doing some really interesting research with our biofuel company, looking at the use of marine biodiesel. And it's also partnering with the university in Singapore, looking at hydrogen fuel cell technology as a method of ship propulsion. So there are many ways really that an SBT can really drive innovation within an organization as well. But those are the key ones, I would say.
Great. Thanks, Mark. So Ellie, coming back to your sustainability-linked bond, you touched on this a little bit already, but it's probably good to elaborate. So the target or the sustainability performance metric that is the basis for this SLB is renewable energy procurement, right? So could you elaborate on how you came to choose this target as opposed to something like science-based targets, which does form the basis for other sustainability-linked loans and bonds out there?
So there are a couple of major reasons behind choosing this particular sustainability performance target for the bond. So one being why renewable energy or why not SBT? So as I touched on earlier, we're still working very hard towards a commitment to SBT's 1.5 degree scenario. And as many of us understand, SBT does require tracking and reducing scope 3 or indirect emissions. So in the context of our building business, that has to do with understanding how our tenants are consuming energy, and also in our construction business, what is the embodied carbon level and the reduction potential in our building materials. And these scope 3 data typically take a lot of engagement to help our stakeholders understand what kind of data are required to be collected, and for us to understand whether technology or more training or more, say sensors have to be put in different buildings to, get these sufficient data for setting a science-based target meaningfully and impactfully. And to be quite honest, we're still working hard on all of these tasks, and we're not there yet. But coincidentally, we have an opportunity to issue a bond. And internally, we want to make it, a commitment to our ongoing ESG integration. Therefore, we tried a sustainability-linked bond. So before we are able to, commit to and declare our SBT, we decided to see what we can establish as sort of a milestone before actually declaring an SBT, and renewable energy to drive down our scope 2 emissions, meaning from our electricity purchase, is one way to go. So therefore, we decided to, align to international best practice to declare, 100% renewable energy for our core business, which is rental properties, by 2026. And a lot of people also ask why Greater Bay Area, even though, New World Development has properties across Greater China. So the geographical focus is to echo our business strategy, which is another reason to, reinforce our ESG integration into our overall business. So the Greater Bay Area, which, is a cluster of 11 cities in southern China, is a core development zone for New World Development, New World Chinaland, and also the brand K11, which operates malls and office buildings and some service departments. So we want to make sure we can deliver what we promised by driving 100% renewable in this cluster of GBA rental properties first. But actually further to the sustainability-linked bonds target, we also disclosed our renewable energy roadmap. So the 2026 GBA milestone is literally a checkpoint, because beyond that, we also introduced a 2031 target to go 100% renewable for our Greater China rental properties.
Thanks, Ellie. So just a quick reminder to audience that if you have questions for the panelists, please do submit them via the Q&A, and we should have some time for that at the end. But Luann, coming to you. So as CIMB, you're sitting on the other side of the table from companies on these deals, and you've started to dip your toe into the world of sustainability-linked financing. So how does CIMB ensure that sustainability-linked debt instruments are credible in terms of the sustainability performance and also generating additionality in terms of real-world impact?
Yeah, so we in fact just launched our sustainability-linked loan product or intention actually around this time last year, and we've actually in terms of the interest and the amount that we've approved, and it's actually surpassed our targets by quite a lot because we're one of the first movers in the market. Now, of course, there's a lot of interest because the first thing clients think is, ooh, discount, right? So yeah, which is a great hook because this is what we want to do to get the conversation started. But then we start telling them, okay, about first of all, you need to make sure that your performance targets are material to your business, and often the question is, what is materiality? So this is the kind of level that we're talking about. So this is actually a great way to get that conversation started. So the three things we really look at is materiality in terms of area as well as in terms of absolute impact. The second thing is, of course, additionality, and this is something that a lot of clients don't really kind of understand because they feel that whatever they have already in plan should be rewarded, and they're doing a good thing. Therefore, we should give them interest rebates, etc. So this is usually a tough conversation that we need to have. So we need to see a real and material uptick in terms of what they're achieving. The third thing is validation, and this is also really important because it needs to be something that is not at the end of the day something that is greenwashed or something that can be disputed. Now, and that is actually one of the reasons why for one of our SLLs we went with CDP as a sustainability performance target because that is public and the results, the methodology very clear, and it's a third party, and there is you don't need to spend a significant amount of money trying to get a third party validation and to do things like that. So wherever possible, we do try and look at the indices such as CDP or DJSI because that is both holistic as well as independent. But of course, we also do need to make sure that whatever they're doing in terms of the additional and the positive impact, we also need to make sure that at least they meet our sector requirements and our financing requirements, which we apply to all lending, just to make sure that because when we announce an SLL, it then becomes very, very public and comes under a lot of scrutiny. So we need to ensure that overall the company and even the company group is really on the right track, has the right intentions, and not just trying to pull a fast one with the media. So that's all.
Thanks, Luann. So I had more questions for the three of you, unfortunately, but we do have to leave some time for audience Q&A. And so I'll just turn to one that we've gotten right now. So the person wrote, "Hi, Mark and Ellie, thanks for your sharing. In spite of setting SBT as science-based targets and launching sustainability-linked bonds, do you mind sharing more on other climate practices adopted in the real estate business?" So, would one of you like to go first?
Sure. Happy to start if everyone's okay with that. I think, well, in addition to carbon reduction through science-based targets and disclosure, a big theme that most real estate players are paying attention to is to address their climate risk based on the recommendations of TCFD, the Task Force on Climate-Related Financial Disclosures. So TCFD is has a group of financial experts around the world that basically drafted recommendations for companies to disclose their climate risk and opportunities, and to ultimately quantify climate value at risk to help investors in the capital markets make financial decisions. So in the past couple of years, we're seeing a lot of different real estate players and even stock exchanges advocating for TCFD. And we're also seeing investors, taking more interest, asking corporates directly what if they have a TCFD report in their annual disclosure, and what their related resilience improvement measures have been, and if they are taking steps to quantify the climate risk in their core businesses. So at New World Group, we have taken this urgency to heart, and since a couple of years ago, actually in 2018, we started exploring different methodologies to assess the physical climate risk facing our property businesses, especially in, again, Greater Bay Area, core development zone. So what we have done at that point is to look for a technical physical risk assessment methodology that can be benchmarked against the UN IPCC, the Intergovernmental Panel on Climate Change's extreme weather scenarios. And from there, we have selected two weather scenarios. One is sort of like a medium scenario. Say, what if global temperature rises by about 2.5 degrees? And an extreme one, which implies, the global temperature rising by 4 degrees Celsius. And to understand the actual, potential physical risk facing 14 of our major GBA properties, covering, residential, shopping malls, and just different office buildings, different types of properties. So this particular exercise is as much about understanding what kind of damages that are related to weather events, extreme weather events that have happened to these particular buildings, that it is about, what would be possible in, the future. And we're talking about from 2019 all the way through 2100. And we forecasted different scenarios. Say, for example, if there are extreme typhoons and flood risk, water stress, and so forth. And we have basically scored climate risk for these 14 particular buildings, and we have started putting in place different resilience measures like installing floodgates, and we're currently putting together a set of climate resilience guidelines to educate new project design. And we have very, transparently laid it out in the report. And I'm sure, different players are doing similar things around TCFD.
Thanks, Ellie. Sorry to interrupt. We just want to make some time also to let Mark answer. Mark, very quickly, if you could maybe just list two examples, and then we've got to wrap, unfortunately.
I think, as Ellie said, climate risk is a massively significant issue for the real estate sector because of the life of the assets. So at Swire Properties, they've already conducted a full climate risk assessment of their entire portfolio, looking at all of the 4 RCPs outlined under the IPCC climate scenarios, and have put in place mitigation plans. And very similar to what Ellie was saying, have also developed a set of guidelines to advise future investment decisions. So that's already in place. We've also conducted a major study looking at embodied carbon within our assets, and we've developed a series of guidelines for future buildings and future developments in order to minimize the embodied carbon within our assets. So I think those are some key ones. I think it's also important to realize that climate is a systemic issue. So it's not just simply a case of reducing the electricity usage in order to manage the emissions from the asset. It's also looking at how we manage waste effectively within our operations. So we've been working very, very closely with our tenants, particularly our F&B tenants, in order to minimize the amount of waste that's been generated from our properties. And we actually ran a pilot study looking at working with a series of our assets in Hong Kong, looking at the potential impact to our tenants of the proposed municipal solid waste charge that will hopefully pass in Hong Kong in the not too distant future. So yeah, I think climate risk and looking at climate as a more systemic issue and looking at waste, but also water usage.
Great. Thank you, Mark. So almost like a mini scenario analysis for waste moving forward. So
yeah.
But with that, many thanks to the panelists, Luann, Ellie, and Mark again for joining us and answering my questions. And thanks to CDP for organizing this and having me be the moderator. So I'll hand back to Fred.
Keith, and yeah, thanks very much to all of the panelists for taking the time to join the discussion and share with us today. It's really interesting to hear of your experience and your insight on the topic, and yeah, we hope to hear more from you going forward. Finally, on the agenda today, as we conducted our analysis of companies and cities who responded to CDP in 2020, we identified several outstanding responders, and we would like to take some time also to recognize and highlight some of these regional leaders in environmental stewardship. So let's start with the corporates. And just to note, we are recognizing companies from Hong Kong and Southeast Asia in the following slides. First, we would like to congratulate City Developments Limited in Singapore, who achieved a score of A for both our climate change and water security programs in 2020. This is the third year that CDL is on the A list for climate and their second year in a row on our A list for water security, which is a very strong performance. Worldwide, only 270 something companies, or 2% of the responders, made the A list for climate change, and only 106 companies made it to the A list for our water security program. Also on the A list this year for both the climate and water security programs is PTT Global Chemicals in Thailand, and this is the first time a Thailand-based company is on both A lists. And so congratulations and well done on this strong performance. Continuing, we would also like to congratulate Hong Kong-based and long-term CDP responder we just heard from, Swire Pacific, who is on the A list for our water security program in 2020. So well done to Mark and the team at Swire Pacific. And finally, we would also like to congratulate and recognize Swire Coca-Cola Limited, who also made it to the A list for our water security program in 2020. So the CDP A list is an exclusive list and the benchmark is high. So we would like to extend a big thanks to all of the companies on the A list for their dedication and all the effort to environmental management. We would also like to take a moment to recognize some of the best performing first-time responders shown on the screen, who all received a score of B- or better in their first year of responding to CDP, which is a very good performance. And we would also like to highlight some of the most improved performances in 2020. So AIA, Keppel, StarHub, and Ayala Land all improved their climate change scores from a C to an A- this year or in 2020, while Wilmar International and IOI improved their forest and water security scores by a full grade. Moving on to the city, states, and regions who responded to CDP in 2020, a total of 88 cities globally made it to our A list, which is no small feat given the challenges faced by city governments due to COVID-19. We would like to give recognition to the following 2 cities in Southeast Asia and 7 in East Asia, with 2 newcomers, Quezon City and Pingtung County, who achieved an A in 2020. So well done again, and congratulations to all of the companies and cities on the A list this year. That concludes our program today. I know we are 1 minute over time, but I'll just quickly go through some of the key dates that we have. Thanks again, everyone, for joining, and to all of the speakers for the interesting presentations. As many of the participants we know are planning to submit a response to CDP in 2021, I'll just share with you these key dates before we wrap up. So the questionnaires are already available on our website. The updated scoring methodology will be available no later than March, although we are not expecting any significant changes to the methodology this year. The online response system will launch 12th of April, and the scoring deadline this year will be 28th of July. As usual, we are also planning to host some disclosure workshop webinars in March or early April. And also to note, we are hosting our results launch events for Australia and New Zealand next week. If you're interested in attending those webinars but haven't received an invitation, please do reach out to us. And finally, in case you missed any of our recent webinars on different topics shown on the screen, including some that we have been discussing today, you can follow the link on the slide when we share the slide deck in the follow-up email. So that's it for today. Thanks again, everyone, for joining and taking time out of your day. We look forward to staying in touch. So with that, have a nice afternoon and evening, and we will be in touch shortly with the follow-up materials. Thank you, and goodbye, everyone.